For retired people, the single biggest threat to their financial health is hiding in plain sight. And a lot of people, especially as you've read other tips on the internet in the last handful of years, a lot of people are not aware of this. Now hear me out. A very simple study with 2 basic scenarios proves exactly what I'm about to say, which is that the stock market and investing into it specifically with index funds in and of itself is a huge risk to retirement income. In many cases, for retirees who are living off of an investment portfolio, investing directly in the stock market has the potential to be extremely problematic and maybe even catastrophic. So let's get right into this. Hey guys, if you're new to the channel, my name is AJ. I'm a financial planner, and let's get right into this because we have what is, like I mentioned, a very simple study of 2 basic scenarios for a retiree. In both scenarios, we're gonna use the exact same assumed investment outcomes. That is, we invest a $1 million portfolio into either portfolio A or portfolio B. We assume stock market rates of return based on what the stock market actually did during this 25-year period. We assume a 6% withdrawal rate. Now, should we be using 6? We'll talk about that in just a little bit. But again, we're assuming you're spending $60,000 a year off of your $1 million portfolio. And finally, we're assuming that the cost of living is growing by 3% per year. So your $60,000 annual spend increases with inflation by 3% compounding per year. And right away, let me direct your attention to the second column, which shows that this common notion that investing directly in the index, we're looking at the S&P 500 index, the broad US stock market, this common notion that investing in an index fund in the stock market is the best way to invest is disproved very, very quickly here. So if we assume that $1 million portfolio starting in the year 2000, if we assume that 6% withdrawal rate, notice when this portfolio value hits 0. This is in year 12. I mean, this is the glaring point that I want to make here in this video. This is the massive point that anyone getting close to retirement, or certainly anyone in retirement, needs to be aware of. This retiree, and by the way, this is not hypothetical. This was like a real example for maybe hundreds of thousands, if not millions of people who retired right around the year 2000. If they left their entire portfolio invested in index funds in the stock market and took a 6% withdrawal rate, they went broke. They went broke relatively quickly. They went broke in year 12. So that is retiring at age 65, running out of money at age 77. Now I'm 77 years old and I gotta go back to work, or I only have my Social Security of maybe $2,000 a month to live off of. This is a very real risk for just about every retired person everywhere. If you happen to be a fellow YouTuber watching this video, I'm pleading with you to stop preaching investing only in index funds to 99% of investors out there. It just does not work for a portfolio of a retired person who is taking distributions. The last very important point I want to make before getting into the first scenario shown here is that this second scenario has the highest rate of return. And I'm going to show you exactly what that is closer to the end of this video. But it's very important to know this second scenario, in which the investor goes broke in year 12, has a very high average annual rate of return during the time period shown. It looks great on paper. It's like, hey, look at the S&P 500 index. Look at this Vanguard index fund. It has a great average annual return. This should be what you're buying in retirement. That's not the case. Even though it looks good on paper, even though it has a high average annual return number, it is not the right solution if someone is relying on this portfolio for the income that they're living off of, and if they don't want to go broke. Okay, shifting gears here now to the first scenario. And I had to explain this to a new client of mine just a couple of weeks ago. In this first scenario, what we're looking at is a portfolio focused on income. And for the purposes of this video, you should think of this portfolio as something about a 70-30 portfolio, 70% in a diversified stock market portfolio and 30% in the bond market. That 30% in bonds is in income generating bonds rather than like zero coupon bonds. And importantly, all of the 70% that's invested in the stock market is invested in stocks with a focus on paying income. That could either be through dividend payments or through preferred stocks that are paying interest. And by the way, you can replicate this left side or this first scenario in many, many different ways. Although this study uses a specific fund or portfolio, there's no one right way to do this. Almost any scenario where we're generating a good amount of income through a 60-40 or a 70-30 type portfolio is going to hold up with relatively similar results to what we see here. And you may have already noticed at this point, the results look very, very good for the retired investor. So all the exact same assumptions that I described a little bit ago, starting in retirement with $1 million, pulling out a 6% withdrawal rate, in the year 2000, notice, make the comparison, like even on year 12, where when you invest in an index fund in the stock market, you're totally broke. In this scenario, you're not only not broke, you've grown the amount of money that you have. And yeah, this is with the same annual withdrawal rate of 6% coming out of the account. Maybe more importantly, now look down near the bottom of the chart right at the end of 2024, going into 2025, not only again has our portfolio continued to grow, we have our original investment has become a little north of 1.8 million. But the biggest point here that any retiree needs to be looking at and needs to be aware of is the amount of income that's been taken out of this hypothetical portfolio. And that is over $2 million. This is so powerful. We need to reiterate this. I started with $1 million 25 years ago. I've taken out over $2 million from that original $1 million investment, and my portfolio sits at 1.8 million. We could say the total value is over 3.8 million of that original $1 million investment. Obviously, any person who's planning for retirement or certainly in retirement is going to prefer this option. The first scenario where they don't go broke in 12 years, where they get to live off of the nest egg that they generated, and where they continue to build their net worth throughout retirement for whatever other purpose they may choose, or to leave a legacy through their estate plan. Now, it's very important to reiterate what I mentioned after I described the other scenario where we invest in index funds, which is about the average annualized rate of return, and we're gonna go to that slide here right now. Highlighting the most relevant areas, because this grid is laid out slightly differently. The first scenario, where we pull out $2 million and we still have 1.8 million, has a far lower average annual rate of return than the other scenario we looked at, which is the S&P 500 index. Let me say that again, because I cannot overstate the importance of this. When you're retired and you're living off of a portfolio like this at a 6% withdrawal rate, the portfolio that has a lower rate of return, but generates more monthly income and has much lower drawdowns when the market gets ugly, that portfolio with the lower average annual rate of return is almost always the better option for the retired investor. It is literally better to choose a portfolio with a lower average rate of return, assuming these rules that we're looking at in this study. And to say the same thing in a different way, the portfolio with a higher average annual rate of return, being the S&P 500 invested directly into via index funds, is the worst portfolio. The higher returning portfolio, if we're taking distributions and if we're taking those distributions during periods of time where the stock market is down, the portfolio with the higher average return is the worst portfolio. It's totally opposite to everything we've ever heard about in the financial media. It's totally opposite to what people preach on when they're talking about investing in the S&P 500 through index funds like SPY or VOO or any of the others. I hope that every retiree in America sees this exact study or hears these words, because it's just so counterintuitive that a lower returning portfolio might be better for them, assuming that lower returning portfolio is generating more income and is more stable. But that's just the reality of retirement distributions, taking income off a portfolio in retirement. I mean, just looking at these numbers again, it's crazy. It's almost half the rate of the return. The 10-year average is 7.8 instead of 13 and change. The 5-year average of our portfolio that worked well is 5.6 compared to the 5-year average of the index at almost 15. So it's almost only 1/3 as high of a rate of return in these most recent years. Now, of course, the second scenario, invested in the stock market, didn't even exist in the 5 most recent years because the investor had already gone broke. But yeah, wow, I think you're seeing the point that is being illustrated here. This is a big deal. Now, any big fans of index funds at this point in the video might be going, yeah, okay, sure, AJ. I see that if I took a 6% withdrawal rate, I went broke in 12 years, starting in the year 2000. But most people know that 6% is too high a withdrawal rate. Maybe they're doing 5, or even the number that gets thrown around a lot more often, which is a 4% withdrawal rate. And that's a fair point. If we look at the S&P 500 index at the same time period and we use a 5% withdrawal rate instead of 6, you don't go broke within 12 years, you go broke in about 14 and a half or 15 years. So whoopee, now instead of 77, you're 80 years old when you have to go back to work. How much better is that really? I don't know. But the other very practical thing I'd like to say is, yeah, cool, you could spend less money to let your portfolio last longer, but if you don't have to, if you know that scenarios like the first scenario exist where you can have an income focused portfolio and live off of a 6% withdrawal rate, who wouldn't want to be able to maximize the nest egg that they've built up for their work during their working years for their retirement? Like, why not take the better alternative that generates you more income? You know, we don't need to be having this, is 4% too much? Maybe we should do a 3.5% withdrawal rate in retirement. We don't really need to be having that conversation or argument if we know that better alternatives exist. Let's actually talk about how to maybe utilize something that is the best potential portfolio for any individual person. Finally, I'd just like to say, neither of these things are my own work. These are just published studies that you can see specifically from a company, in this case called American Century. But again, you can replicate the first scenario, which is more like a 70-30 portfolio in many, many ways. So it doesn't take me or anyone else out there on the internet showing you how to do that. If you have an investment provider, you can ask them about an income-focused 60-40 or an income-focused 70-30 portfolio, and they'll be able to put together something very similar, if not super similar. It will be relatively similar to what we see in scenario 1, where you can make a much more successful retirement happen. Last point is maybe just to note that we're specifically talking about distribution phase. So once someone is no longer earning income and saving into an account, and rather now they're spending money out of an account. So the math that I've been discussing in this video is totally opposite. If you're young and accumulating like myself, you'd actually rather have the portfolio with those higher average annual returns, even though they have larger drawdowns, just mathematically speaking, because during those drawdowns, if you can make more contributions and buy stocks at highly depreciated values, it gives you more future appreciation potential moving forward. So that's a separate conversation. But to summarize all this, when we're looking at distribution phase in retirement, people should be aware of the fact that just investing in index funds may not be their best option and actually may destroy their financial health, but rather investing in lower volatility and lower returning, but income-focused portfolios can make a lot more sense. As always, thanks for watching.